I heard you say a couple of things today on the show. I heard you say, when you invest, you have to believe in your thoughts. I like this idea of the 3 E's: ethics, energy, experience. And 3 is a magical number, but 2.5 is good enough. This idea of leaders feed everybody a part of the cake, I really like. This idea about being intentional, about mentorship, methodical, systematic. And the last thing I'm really taking away is, be an optimist in the long term, but be flexible in the short term. Great. Thanks for joining another episode of Talks with T. I'm truly humbled to have Imad Ghandour from Cedar Bridge joining us today. For those who don't know about Cedar Bridge, can you just provide a brief introduction?
Yeah, thanks, Tarek, first of all, for this early morning podcast on a rainy day. But Cedar Bridge has been set up now for a good 12 years. And initially, we started as a growth capital, small buyout firm in 2011. Raised a very small fund, and there was a story behind it. I am happy to share it later. But
we love stories on this show, so
I'll tell you the story. I'll tell you the short version. So prior to that, I was working for Gulf Capital, and me and my partner decided that there is an opportunity. Gulf Capital invests $50 million, $100 million a ticket. Yeah. So we were more keen to invest in smaller businesses and really, roll our sleeves and, grow them up and help them to grow. And we thought nobody is touching that space where you invest $5, $10, $50 million and grow these brands to become more regional, more international. So to cut a long story short, we told Karim Sulah, who was a friend and also, the CEO of, that we're departing amicable terms. We're not going to compete. And we shook hands and we left, set up Cedar Bridge. Yeah. And at that time, there was a fund of fund based out of the UK, and they were very keen to invest in the Middle East. That's 2010. Yeah. And they wrote us a $50 million check, on the get-go. Take 50 million, raise another 50 million, have your small, fund of 100 million. And we decided then to base it in Cairo, because Cairo was booming in 2010 and prior to that.
Interesting.
Even identified the location. We're about to sign the lease on the 1st of February 2011. Sitting on my TV in Dubai, around at when was it, 25th of January 2011. Yeah. And there were few demonstrations in Tahrir Square. Okay, I said, the police will crush them. 26 January, it's growing. 27, it's full-fledged, Arab Spring rolling into Cairo. Yeah. And, that we know the history. Yeah. And, all this was scrapped. And then a few months later, our this anchor LP came to us and said, you guys, look, the whole Middle East is blowing up. Take this settlement and, bon chance. Yeah. And, so we went back to friends and family and small investors that we know, and they trust us. And we raised a much smaller fund. And that was Fund 1, and then we did well. And then there was Fund 2, which followed the same strategy. And the strategy was quite creative, again, because of pure chance. So the first guy we went to from the friends and family, he said, I don't like PE because, I put my money for 10 years, I don't see a dime. And we told him, we'll give you a quarterly dividend. You're going to get 5 to 10% every year, and it's going to be paid quarterly. And where we invest, we know that these businesses generate cash flow. So it's nurseries, beauty salons, hospitals, and so on. So there is a lot of cash that comes out of these businesses. And we created a strategy which we don't think exists anywhere in the world called growth and distribution. So we grow these businesses, but we also pay dividends.
Very interesting.
And we got stuck with that strategy for the second fund and now hopefully the third fund. Which we called growth, and we coined the term growth and distribution strategy, and the Arabs love it. I mean, in the West, pension funds don't want their money back. But here they want tawzi'at, they want their dividend. People love it. Even you'll be surprised. I go to like big family offices. We love your dividends. Let's pay our salaries.
What gave you the conviction that there was this gap of smaller ticket size? It seems like it's more attractive to deploy bigger capital, have a bigger fund, bigger carry, right? And so what gave you the conviction that there was something here?
Look, I've been an entrepreneur. I started many businesses before. Some worked, some failed, some I sold. So it is something you like, when you like to work in a business and see it grow, and you go to Saudi and then you go to London, and sometimes some of our businesses say are in Boots, so I go into Boots and see where they are on the shelf. When you're running a $100-200 billion business, you don't have that touch with reality. You're sitting on a board or a committee trying to figure out much bigger things. Your debt to equity ratio, or your big cash flow, or this and that. So that's a personal preference.
If I'm not mistaken, you were a computer engineer by degree.
Yeah.
How did you navigate your world into the private equity space, and even that, at a very early stage of private equity? What was your journey into private equity? You mentioned you started a couple of companies.
So honestly, it's all unplanned, and I started as a computer engineer. Even I went to the US to study in Wisconsin. I went to study MBA in Management Information Systems.
So
MIS. So, and I thought that's my track. And then I said, I don't want to be around geeks a lot. I want also to make around business people making money. So when I went back to Beirut, I started doing consultancy work. So shifted a little bit, and it's all common sense business at the end of the day. And as you consulted for businesses, you get to know most of the businesses we consulted for, and the projects were investment projects. Invest here, invest there, all over the board. So you kind of understand investment banking. And if I bought a McKinsey valuation. It's a book. It's a huge book.
It's the famous.
It's a famous standard.
Book,
so I read it, cover to cover. I understood what valuation is, and then I sat with lawyers. I understood what share purchase agreement is and shareholder. And you teach yourself. And this is how I learned private equity. I mean, when we started, when private equity started in 2003, really in this region, it was Abraj and at that time HSBC Private Equity. They both raised $100 million fund. Nobody knew what everybody was and they were trying to figure it out, and how do you write this agreement, that agreement, buy shares and under the UAE company law or Saudi company law. So everybody was learning, and I joined the bandwagon.
What companies stick out in your memory as being ones that were defined as a success, regardless of the financial outcome?
Look, we proud ourselves that we've built some very nice regional or even global businesses. Under Gulf Capital, one of the businesses where I proud myself that I led the investment, at least the part with a very nice management team, was Metito, which did water desalination. And it was already it went beyond the region. They had operation in Indonesia and in India. But I championed their entry into China. again, being tenacious and found the right acquisition target, bought it for them, and then bolted onto that. And China became one of their largest operation, which eventually led to Gulf Capital exit of their stake. They sold it to Mitsubishi, or the biggest chunk of it, they sold it to Mitsubishi. Because Mitsubishi was interested in China and the Middle East. But China was, China is China.
Yeah.
So, and it was a great deal. The company made a lot of money out of it. They became the third largest operator in China. And, and the Middle East, they were number one. So,
Yeah.
And then they went to other places as well. So that was one very interesting example. Recently under Fund 1, Cedar Bridge Fund 1, we built the largest chain of nurseries, which we eventually sold to a French group, still growing and still number one. And, I see that as a success. Not that you sold it and, bye-bye, I took my money, the hello to it, but it actually continued growing and prospering. And, you feel that you did something, especially in education, and there are kids.
For sure.
And, so there is that payback that's not necessarily monetary.
Yeah, Kids First Group is actually a Bezat client. So,
really?
So I know the team there.
Yeah.
Starting anything from scratch is difficult. Starting private equity fund 12 years ago, I'm assuming was equally, if not more, difficult. So I'd love to kind of hear about the origin stories of setting it up, what you learned along the way in the initial days.
Look, it was Arab Spring. It was financial crisis just a few years before that. So.
Your timing was great.
But that was the best timing to invest because everything was down. Investment valuations were down. And then there was a good run for 4 years. So the Fund 1 did extremely well. But, you have to believe in, when you invest, you have to believe in your own thoughts. And I'll go to the Metito investment. When we invested, we bought this company in China. Everybody thought, this is like, it's not going to work. China is big, they're going to eat you, capital controls, It was a slam dunk in my view because the valuation, we bought it at rock bottom valuation because the seller was European. There were some issues they needed to sell and so on. So sometimes, you just have, sometimes you have to listen and sometimes you just have to do what's in your, in your mind. Same like one of the first investments we did under Fund 1 was 3 days after the collapse of the Mubarak regime. So on 14th of February, I took a plane into Cairo. Everybody thought I'm stupid. 3 days he left the office.
Yeah.
We landed and negotiated one of the best deals as well into another educational group. So you just have to be that, clear where is the value and do that. That's one. But also another big thing is my co-founder is Majid al-Makhlouf, and he's a great support. And all the team is a great support, but he's been with me the longest. And, sometimes I learned sometimes you try to be like, I did this, you did that, and, you try to measure whatever. But sometimes even if somebody is contributing 10%, but his presence in your life and in your business actually makes that business grow even with a minimal contribution. And it applies also when, you talk to companies you invest in. Of course, most of the burden day to day is carried by the CEOs, the managers, the founders, and so on. But the presence of the right investor, although they don't really put the hours, but their presence and one decision, will actually save you a lot of money and will make you open your eyes to an opportunity which you never, thought will, or a contact will open the door which you'll never have. And of course, you put 99% of the hours, but that has been a monumental shift. And Kids First, many examples. I mean, the early decisions we took or didn't take made that group successful, and since they're your clients, you know how successful they are.
Yeah.
So we avoided a lot of disasters because collectively we're sitting on a table and making decisions.
So this idea of when you invest, you have to believe in your thoughts. How do you know if you're right or wrong?
Look, it's I wish I have the answer. It's you have to remove your ego. You don't want to do it because you're gonna grab the title and get your name in the papers. And you have to be scientific, trying to be scientific. And then there is always a hunch, a gut feel, but there should also be a number to support it. It's an art. Investment till today is an art. It's some people do it very well. Some people do it extremely well. Warren Buffett and so on. And it's an art. It's never been a science. Even if you go study it here and there, some MBAs and so on, it's still an art.
So there's a lot of methodologies around investment criteria, investment methodologies. So how do you create the balance between this mathematical, scientific side of investing and the art side?
Look, you have to do the science.
Yeah.
Just the art will probably lead you to take wrong decisions eventually, big wrong decisions. But you have to combine the two. And this is why eventually the outcome gets people the respect that when they say no or it's not going to work, so if with your track record with time, when you say no, that people know that there is something that outside what they can understand, and it's not going to work. Sometimes it's just meeting the founder. You say it's not going to work. It's a very multi-dimensional decision that it's sometimes hard to articulate in the right way, and sometimes it's when you try to add it up, it doesn't add, and you say it's too complex. Just leave it.
And what kind of approaches do you use to validate or try to, before investing, try to determine whether or not your thought process makes sense, whether or not your hunch is in the right direction?
There is a very standard frame, and it's now public. Everybody uses it. So we follow that frame, and we kind of articulate it, more focusing on the people, because the team eventually might steer, pivot things, through time, which is important. And understanding that these guys have the tenacity, they have the ethics. I have what I call the 3E formula. So ethics, energy, and experience. And it's very rare that somebody will actually score 3 out of 3. But as a minimum, you should be at 2.5. So you should have the right experience, say, and the right ethics. But maybe you're older and your energy is not the right energy. Or maybe you're a young guy with a lot of energy, a lot of ethics, but your experience is 50. You don't know exactly, but eventually you'll get it. So if you score 2.5 or more, then you've kind of cleared the at least the human part in my eyes. Everybody has his own formula, of course.
How do you measure the ethics piece?
Look, I mean, ethics, and again, even if you don't score 100, I'll probably invest. And it's the most controversial of the E's. Look, there are thieves, and they score 0, so you're not going to invest there. But there are people that are super right. They'll go a long way to make sure that your rights are preserved as an investor, and so on. And these will score 1, and they'll report on time, accurate, everything. But there are people who will be in the middle, and they will follow their interest without being necessarily unethical, but they'll put their interest first. So these are the people in the middle. And if they have the experience and energy, but you try to basically manage that piece, I'm happy to to follow
Yeah.
them. And,
Yeah.
but it is the most controversial of the three. I mean,
Yeah. And in terms of, you said that a lot of investments art, there's this kind of hunch you get. How do you think about building a sustainable long-term firm at Cedar Bridge, where a lot of these investment approaches happen at your level where you have a hunch, and how do you translate that down to the team to build something?
look, it's a hunch, but it's a debate, and the team will always come out to be to make the right decision as a team. Invariably, I would say anybody who just make one by himself the decision will end up worse off than a team making a decision. And then you need the right team dynamics and the right balance and the right time and enough time to debate stuff. So it's always a team decision at that. And if I'm overruled, if my hunch is overruled, it's overruled. And, it happened.
Okay. And how do you foster that culture of everyone being open to debate, being ready to push against the founder around, his or her thoughts?
Yeah, the onus is on me to make sure that as a founder that I don't alienate people or. So, speak your mind. You have to push it. You have to tell people, speak your mind. Tell me why. Anytime we invest in a business, or we appoint a CEO if we own the business, or I tell them always push back. I give you the license to push back and debate it, and my duty is to give you the time to debate it. And we can debate it for hours, and then one of us will get convinced. So you have to foster that you have to consciously foster that because automatically people will say, he's the boss, he's the senior managing director, don't touch him. I don't, my bonus is here or there,
Especially in the Arab world and, let's call it more Eastern Hemisphere type cultures, this idea of pushing back against your management team is...
we're a very relaxed culture, though, so we're always relaxed. We involve everybody. We engage everybody. Everybody can see any information. We're not holding the cards close to our chest. All this helps people to know, if somebody asks me, well, I'm not doing this or that, go, the financial statements are there, look at them and see if you can get a bonus or, get a raise or raise the staff salaries or whatever it is, It's,
And obviously you've invested in several companies, several entrepreneurs. I'd love to kind of get your insights from investments that went sour, what you learned about what to look for in entrepreneurs.
Things that went sour. Look, what we look at entrepreneurs is, let me start with that. It is the tenacity. Okay, they have to have the perseverance, the tenacity to really push, because it is a long and bumpy, journey. There'll be, we have now several situations in Egypt where, because of the currency, it's a hiccup. They were doing extremely well last year, and then boom, big bump on the road, So you have to pull through, and luckily we have invested in a few of those entrepreneurs that you said, you know what, I'm going to ride it through. It's going to be, I'm going to do layoffs, I'm going to do this or that, but I'm going to ride it through and get out better and stronger. And that's an important piece of the character. So that's one. It's a multi-dimensional. Character is multi-dimensional. Again, going back to the 3 E's. Does he have, the energy? Does he wake up at 6 and run? Or he wakes up at 10? Then that's a red flag. Does he have does he treat people well, because we're part of his ecosystem, but not us also, his employees, his suppliers, his clients. Or he doesn't treat people well. So it's a lot of things you look at. I don't think I haven't got the formula, honestly, Tyler.
You mentioned that you kind of brushed on your co-founder. So I'd love to hear your thoughts around having a co-founder versus not having a co-founder, both kind of, I guess, first at Cedar Bridge, the impact of having a co-founder, and then the businesses you've invested in, where there's a solo entrepreneur versus multiple co-founders.
Yeah. Look, the co-founder, in this long journey, and as you hit bumps and, you have issues and you need to make decisions, having somebody on the table who has the same stakes as you, and he's not just employed, it's allows you to discuss things and make decisions as a team much, much better. But it's a marriage, not every marriage will work, and not every character has the same chemistry, and so you have to pick the right person. And chances are you're not going to pick the right person, but, as we know, like in marriages. But it's if you're lucky and you pick the right person to go with you through the journey, I think it's a much lighter burden. Because when you're not getting the funding and your cash runaway is 2 months, you're thinking of paying the salaries at the end of the month. At least there is somebody who shares that pain, and you can sit and talk about
Misery
it.
likes company.
Other than talking to yourself, it's a lighter journey. And you have to remember that eventually, when you are prosperous and you're a unicorn and you're cashing out $1 billion, you have to remember that person was there besides you, and you might be the bigger shareholder or whatever, but you have to remember that he was part of the formula. Not forget it. Once you're a superstar, who are you?
Yeah, 100%.
And
so I think there's a part which is finding the right co-founder, but then you mentioned that rightfully so along the way things happen in business. And so what kind of setup, structure, things you've done that you found effective to continue to nurture and maintain a strong co-founder relationship?
Look, I learned it. Honestly, it's something I learned through the Cedar Bridge journey, because that was the first time I had a really long-term co-founder. So I learned later the benefit of having a co-founder. And now a lot of times people ask me, like, my co-founder is not doing this and I'm doing that and he's not doing it. Look, you have to look at the whole package. It's never a very precise formula of who is contributing what, because sometimes 1 + 1 = 3, and you remove the 1, you end up with 1. So, and actually that's a lesson that I learned from Hassan. So Hassan Jawad, he told me, the president of the U.S. makes I think $400,000, but he decides the world, and of course his contribution is much more than $400,000. So you cannot measure things just like pro rata to your contribution. It's you have to look at it in a different way. When you're a leader, you just have to feed everybody and feel satisfied with a proportionally lower part of the cake. Don't try to measure it if you're a true real leader.
Yeah. You alluded to some of these, but I'd love to hear stories along the way building the company, Cedar Bridge. Stories that are, or a story that's memorable around when you hit a pretty significant roadblock and how you navigated it.
Yeah. Look, in many instances, something that comes to memory is when COVID happened. So at that time, we had limited exposure to tech. We were launching our tech fund. So we had only one investment in tech from the existing 2 funds. But the rest of our businesses were all, client-facing. Or most of them were client-facing. And suddenly, and they're in the UK, they are in Cyprus, they're in Egypt, they're in Saudi, they're here. And suddenly, if you even, try to dream of that risk in your information memorandum, you couldn't.
To put it on the list and then to assign a probability to it, or
So, suddenly, the UK shuts down, and then UAE shuts down end of March, and then Cyprus, and luckily in Egypt we had a chain of labs, so that worked. But initially in the first month in March, April 2020, it shut down as well. It, emergency everywhere. Nobody is allowed to go out, curfews and so on. And I had, so what shall we do? It was mid-March, and you just have to shift your mind into a different gear. This is not going to go away.
Yeah.
And instead of thinking of growth and plans and hiring and where to open next and you're thinking shut down everything, minimize cost, fire as many people as you can, put them on lower salaries, and you have to sit with every team and convince them of your vision. And remember, you're doing this again suddenly over team or Zoom at that time. And, you have to convince everybody. So we put a cash flow meeting for every company every week. And you cannot buy a pen anywhere without our personal permission, me, Magellan, or Mo, my other partner, and so on. So we have to decide on every purchase. And then we went through, I think, 10, 15 points of cutting cost and talking to landlords, talking to suppliers, the whole story. But it was a nerve-wracking, probably 2-3 months, where you're faced with like Armageddon, day, and
how do you manage your own psychology during?
Honestly,
like that?
I learned meditation.
Okay. You learned meditation during this period.
So, every day I'll be like drained. At the end of the day, you're just facing so many issues, cash flows, people shouting because they also have their issues, right?
Have their,
personal or suppliers and end of the day you're drained by the magnitude of the problem. And then I forgot how somebody told me, I think another one of my friends told me, try meditation. And I started meditating every morning and every evening, and it's amazing. It's I stayed with it till now.
Yes. So I guess I'd love to also understand a bit more what you've learned about founder-investor relationships, how to manage those for entrepreneurs, what you've seen work, what you've seen that doesn't work.
Yeah. Look, it's first the investor has to learn how to invest. And how to work with other people as an investor. There is always I'll be self-critical for the investor community, let's say. There is always a assumption that we know more because we have the money, and you're coming to the table, and we've seen so many, and we're the kings of the universe, and that's wrong.
Yeah.
Because yes, a little bit here and there, and you've seen more. But the day-to-day small decisions taken by the founders and their closeness to the problems and the markets and the people and so on make them know more, and they have to deal with balancing act between everything: cash, people, markets, small requests here and there, and so on. And so you don't know more. And when you want to give advice and tell the founder in the board or, do this, do that, be cognizant that you don't know more.
Yeah.
Okay?
Yeah.
And I feel that in most cases, we as investors feel that, we have a superior access to knowledge and experience. And in most cases, that's wrong. I don't think that's misplaced. Having said that, I think in terms maybe of strategy, in terms of, mentoring the founder more as a mentor, This is where we should put more effort. And talking to him, he's holding all the startup, trying to push everything. I mean, he's been through that journey, right? I mean, to take off. So you need to help him psychologically too. And that's, I think, where we need to place more effort and help him in that area, rather than tell him, do this, go to here. Why is the wall black, not red? People like red. You don't know these things. Let him do his stuff and judge at the outcome, end of the week, end of the month, and end of the year. So, so I think it's a learning experience of how to handle the relationship. Some people do it better than others. Some people are totally silent, which is also bad. And some people are totally vocal. They want to jump in the seat of the founder, CEO, and run the ship. And that's also totally wrong. You need to have basically know what you know and know what you don't know, and where you should interfere and where you should not interfere. That's from the investment side. I think on the shareholder, on the founders or the side, they have to understand that eventually they need to make money for this investor. It's for their own interest, for a healthy relationship. I rarely find somebody coming saying, we're gonna start here, and I want you to make this return, and I'm going to make this return, and this is the right balance. Always it's one way, they look at it in one way. And this is, I think, another reason why, there is a bit sometimes of a confrontation, everybody pulling the cover to his side. So
Yeah. And what have you learned kind of along the way around, if I'm an entrepreneur, I'm trying to manage my board, I'm trying to make sure there's the right level of debate, but it's not tension. What would you advise an entrepreneur on how to approach it?
Look, get people who are engaged, but not overly engaged. And with the right experience.
And how do you measure the engaged versus not overly engaged before they get on the board?
I mean, overly engaged is when somebody starts texting you or calling you every week, every day. Why this? I was in the, listening to this guy. He told me that your service is shit. Okay, so that's over engagement. Engage is making sure that you, again, following that, more mentoring approach. Once you invested and things are working, plus or minus as expected, use the time to mentor the person. Sit with him for lunch. Are you okay? Are you overworking? Is your personal life okay? This is where we can add value, because maybe we're older and more experienced. We've seen the cycle. Is your funding fine? Your runway is too short. You need to think of your co-founder. Don't treat him like things of that sort. I think that feedback, is more beneficial than trying to pick on why did you do this, why you didn't. We shouldn't be selling. I've seen so many of these mistakes where the board starts saying, sell to X, don't sell to Y, or to address this segment, not that segment. And then we do the shift or the pivot, and then it's wrong. And
And how do you, so outside of just the investor-entrepreneur relationship, what are some things you learned about how to be an effective mentor and how to approach mentorship? So, for example, for me in my business, if I want to mentor people who are coming up through the ranks?
It has to be frequent, not ad hoc. So if I'm mentoring somebody, it's every month on Monday at 11 we meet, spend an hour, casual. It should be something you look forward to, something where you eventually build the trust relationship, grow that trust relationship, you open up, you can discuss things, and you keep this, somehow a secret. I mean, you don't use it against the mentor. It's a difficult one, because one day you're talking about things that might work against you as an investor, so you need to find the balance.
And, it would be a shortcoming from me if we don't talk today about what advice you'd be giving entrepreneurs, especially in the tech space, in this kind of economic environment. I mean, to a large extent, the economic environment hasn't really hit the Middle East yet, or may not, depending on your views. But a lot of entrepreneurs, myself included, have been used to an environment where fundraising was much more
abundance of capital.
And so now that dynamic has shifted.
Yeah.
And so if I talk about myself, my co-founders, we joke that we're now being forced to learn how to run a real business because, cash is king. And it was something that we didn't have to think about. And so for us, it's a mind shift change. Yeah. Luckily, I had spent time at GE and I had seen on the finance side. So I had seen, good times and tough times. So things like a P&L, a balance sheet mean things to me. But many entrepreneurs haven't, right? And so making that shift, what can you share in terms of advice, knowledge, beyond the simple kind of the headlines? Preserve cash, control cost.
Look, I mean, these cycles where there is an abundance of cash have been there before. And, history is a good tutor. In the late 90s, when telecoms were, sold at huge multiples, and eventually that party ended.
Yeah.
And now telecoms are running for EBITDA and cash flow and, so we have to realize that, all these cycles tend to end. And eventually everything is run as a business, and that eventually you need to produce profit. And you need to stop the burn, and you need to see that. And people can understand that it's an investment of 1, 2, 3 years, but at one point you're going to be a real business, and you have to grow as a real business that's profitable to get more funding and so on and so forth. So one of our best investment is in Fresha. I don't know if you're familiar with Fresha. So we were one of the early investors in 2015. And last month when I was sitting with the founder, he's talking about break even. He's been burning cash for 6-7 years now. And, 2024 is break even point where he starts moving into profitability. So everybody has to focus on that, inflection point. And it's not going to continue. I mean, it's whatever it is. If it's the next wave is biotech or whatever it is, or genomics or whatever it is, it's going to be a boom, and then eventually it will calm down.
Yeah,
unfortunately.
Yeah.
So I think it's the end of the party, and we just have to be realistic what to expect.
And for founders or for entrepreneurs who eventually at some point have their own investors and they're trying to think of a liquidity event, I'd love to kind of hear about your thoughts around the different options. So whether it's public market, whether it's strategic, whether it's a private equity, I'd love to kind of hear from your experience, what are the across the options, how do we think about pros, cons?
Again, being realistic, I think most options will be mergers and acquisitions, where you merge, you get acquired. The public markets are difficult. Saudi is opening a window, UAE not yet. Egypt has theoretically a window which was never tested really in a big way. So the public markets are difficult, even in the West, they are difficult. So 90% of exits are around mergers and acquisitions. And that's probably where people should focus. It's a bit, giving up your baby to somebody else who you were competing with. It's not necessarily, the best outcome that you're looking for.
Yeah.
But you have to be realistic that, funding is not as available as before. Even if there is some now, it's being very discerning who to give it to and who not to give it to. And then these funds need to show returns, and they were going to have a hard time to raise fund 2, 3, and so on. So it's going to be probably a very difficult environment for the next few years. So,
and do you see that impacting the region as well?
Yeah, I mean, except Saudi Arabia, from where we sit, I mean, most of the region, Saudi, a little bit UAE, but you go to Egypt now, suddenly the winds have shifted. Whereas Egypt was a main destination for a lot of VCs, where there is a lot of opportunity, and there are a lot of opportunity, a lot of good entrepreneurs, a lot of vibrant, ecosystem. I think that has shifted, and probably the same will happen in other parts as well.
Before we started recording, we were talking about your time in Lebanon and how Lebanon was going through a boom when you went and worked there for 10 years, and to a large extent you learned that it was a short-lived boom. But across your career in the region, you've seen many cycles of boom and bust on a macroeconomic level in different countries. The example you gave in Egypt now, the Arab Spring as well, then your prior experience in Lebanon. So I guess if I'm an entrepreneur and I'm trying to think about how do I navigate these types of risks over an extended period, what have you learned about navigating unexpected macroeconomic environments that unfortunately do have a tend to pop up in the Middle East?
You need to maintain a lot of flexibility. How you, for example, you look at your overheads. People start building 200, 300 people overhead, and then suddenly they need to shift. You need to make sure that it's better maybe to contract what you can contract out, because this relationship can be, the agreement can be in 30 days just terminated, whereas employment is a bit more sticky. So you need to think of flexibility. But overall, there are, of course, big shifts up and down. But it's when you look over the long term, Tariq, it is a wealthy region that has paid back investors. Even Egypt. We've been investing in Egypt for good 15, 17 years. Ups and downs. But overall, I haven't lost any money in Egypt. My average IRR in Egypt is in the 30%, despite everything. I've seen devaluation in 2016. I've seen, revolution 1.0, 2.0 devaluation 2016, the beginning of the year, and then later now. And still, we're optimistic about Egypt. You need to navigate, and that's a skill set probably if you're sitting in London you don't need to worry about, or maybe nowadays you do. But it's something you can master eventually. But I look long term, you can make substantial amount of money, whether you're an entrepreneur or an investor or a business owner or whatever. You can make good money in this region. And you look at Egypt, so many wealthy people came out of Egypt because they're smart. So many startups came out of Egypt, despite everything.
Yeah. Imad, I heard you say a couple of things today on the show. I heard you say, when you invest, you have to believe in your thoughts. I like this idea of the 3 E's: ethics, energy, experience. And 3 is a magical number, but 2.5 is good enough. This idea of leaders feed everybody a part of the cake, I really like. This idea about being intentional, about mentorship, methodical, systematic. And the last thing I'm really taking away is, be an optimist in the long term, but be flexible in the short term. And so I've learned a lot from talking to you today, and I'm really grateful for you sharing your time and your thoughts.
Thanks for hosting me, Tariq.